You have said stay invested. Where?
Well, we're still overweight in equities versus these high-grade bonds, in part because I think one of the stories that we've seen unfold this year is the way that those bonds just can't be the same kind of diversifier for many portfolios out there this year. So while equities are more difficult as volatility reaches kind of average levels, where else do you go? And certainly bonds are less attractive, so we're also talking about hedge funds and other alternatives.
Hedge funds?
Yes.
Their performance. So what are the other alternatives? Hedge funds and what else?
I mean, I think there's private equity as well. The point about hedge funds is, back in the days when I was in the hedge fund world, maybe you'd expect a 20% return. It's become a lot more institutionalized, but it's still something that is less correlated to equities, and that gives you a diversifier.
Well, talking about volatility, this is a chart that has really struck our fancy this whole week. Come inside the Bloomberg here. It's the volatility in FX and treasuries and in U.S. equities. Obviously, the white line is U.S. equities. Why is this happening?
Yeah. Well, I think, this is a period now before earnings get released and we get what we believe will be a reconfirmation of the global growth story, where so much has happened. Going back to Chair Powell saying, oh, that dot plot, we're not so accurate in our forecasts. Then we had Mr. Bolton's appointment. We had changes in the White House. We had questions about tech companies. And then you layer in this chance of a trade war on top of that. So I think there's a lot going on in a period where the economic data we haven't got that reconfirmation yet.
So if this continues, that you have heightened volatility in equities, but not as much in FX or debt, what does that do to the balance of the portfolio? I mean, all things being equal, that would make you want to come out of equities to some extent.
Yeah, and people have. We've estimated that you've got a 5% increase in the equity risk premium now. So some of that is getting baked in. I think that what would really start to concern us is if we started to see these bond spreads widen considerably from here, and if the bond market got more involved, then we'd be more concerned.